Now, we've been watching the economy. It has been deteriorating. And I know Trump is out there, and there's a lot of promises about jobs coming back, manufacturing coming back. And again, these are all promises. These companies really haven't done that much as of yet. It's a lot of talk, a lot of promises. It sounds great in the media, of course. But what we're really seeing is a lot of retail stores closing. We're seeing still manufacturers closing. And we can see already Caterpillar, they're going to be laying off 800 people from their Aurora, Illinois plant. And the reason for this is because there is a decline in demand for their product. Now, we know that Caterpillar, it has had a terrible something like 28 months of declining sales all around the world. And in some areas, they're non-existent right now. And we can see through the past, they've been laying off many, many individuals. Now, of course, here in the United States, we see many things deteriorating very, very quickly. Not just Caterpillar around the world. It's also happening here in the United States. But the manufacturers of automobiles, of course, they're trying to make us believe that things are fantastic with them because they keep coming out with this report saying how great auto sales are. And we have to remember how auto sales are calculated. When those autos are delivered to the dealership and they stuff their lots with autos, those are sales. That's what they report on, not when they sell the car to the individual. And a lot of these cars, again, are sitting on the lot. They can't move them. And this is how you know there's a problem, because when automobile manufacturers, when they start giving out gigantic, I'm talking gigantic incentives to move their inventory, this is a signal letting you know there's major problems. We saw this prior to 2008 where incentives got gigantic. Now, TrueCar, they're forecasting an increase of about 0.2% year over year of new cars and light trucks. And what we're seeing right now, when we look closely at these numbers on how they're doing this, well, first of all, they're stuffing the lots with automobiles. Secondly, they need to move these automobiles off the lots, and this is why they've been giving these tremendous incentives. Now, year over year in February, sales have fallen by 1.1%, and they also edged down in January. Now, the weather really wasn't that bad, so it's going to be very difficult to blame this on a very snowy February. But when we look at the incentives, it gives us some idea of what's happening here. Now, GM, they clocked in over about something like $5,125 per unit in incentives. And that's apparently what it took to get its sales to rise 4%. So they had to give up $5,000 for each automobile. For Ford, which has been priding itself in disciplined approach, well, its incentives were around $4,011. Fiat Chrysler, same thing. They were giving out around $4,362 per unit. So when we look at this and we see how this affects their business, we can see that they're doing the same thing they did back in 2006, 2007, leading up to 2008. GM cranked up its incentives by 21.4% from a year ago. Honda increased its incentive spending 27% a year ago. Now, if GM piles on its incentives at this rate, 3 months in a row, it would spend nearly $4 billion on incentives in just that quarter, just in the U.S. alone. So what are the numbers? What do they look like when we look very closely at this? Well, in the first quarter of 2015, GM reported global net income of $2.0 billion. In the first quarter of 2015, it reported global net income of $0.9 billion. These incentives can eat at automakers' dollars and cents in no time. And they did in the years before the industry collapsed during the Great Recession. So when we look at all these numbers, they're really doing the same thing that they did prior to 2008, where they had to go to Congress and they had to say, listen, because of all these incentives, because we're so far into debt, we're not making a profit, we need a bailout. And they're doing the same thing again. I mean, what's the definition of insanity? Doing the same thing over and over and over and expecting a different result? This is exactly what they're doing. And we could see right now that in this economy, if they have to resort to these drastic measures, that means the economy isn't as strong as everyone is saying. It means that we are in major trouble. We see Eric Rosengren, the president of the Federal Reserve Bank of Boston, recently made a startling admission We may be in the midst of yet another real estate bubble. Major financial institutions in this country are in possession of over $14 trillion worth of residential real estate loans. That's well over $40,000 for every man, woman, and child in America. And we can see right now from these low interest rates, by having hedge funds, having foreigners, investment companies come in and take this free money from the Fed, go out and purchase these homes. They increased the value of homes. They created this gigantic bubble. But look how they did this. It was all fake, phony, and false. While in the meantime, the Fed was buying up a lot of these toxic loans. This didn't help the situation. This just covered it up, swept it under the carpet. That's all it did. We see right now from the Scirocco report that the U.S. retirement market, well, it is in big trouble because what we're seeing right now is annual benefits that are paid out are now larger than the total contributions. And we talked about the pensions in depth, and we are seeing major problems here. Now, Americans who have invested in their hard-earned money into their 401k and had no idea that it was the greatest Ponzi scheme in history, well, they're going to have a huge problem when the whole thing comes crumbling down. Now, according to the most recent data by the ICI, Investment Company Institute, the U.S. retirement market ballooned to a new record high of $25.3 trillion at the end of 2016. As Americans continue to contribute into their supposed retirement plans, few realize that more funds are now heading out that are now going in. This is not a good sign at all. If we look at the most recent data from the Investment Company Institute, Americans contributed a total of $373.6 billion into their private sector DC plans in 2014 versus total benefits paid out of $402.3 billion, which means net contributions were negative $28.7 billion. So why is the U.S. retirement market in big trouble? Well, if you really look at it, it's completely obvious. The U.S. retirement market, well, it has increased right along with the surge in total U.S. public debt. U.S. retirement market's value is being propped up by debt. As the U.S. debt exploded from $875 billion in 1980 to $20 trillion currently, the U.S. retirement market surged from $822 billion to $25.3 trillion during the same exact time period. We need to remember this. We need to understand this, that debt is not an asset. Also, the true value is subtracting total debt from total assets. Now, the reason the U.S. market is a huge Ponzi scheme is that it has a stored digital IOU rather than real physical wealth. A typical stock price is based on net present value. They take the future value of the company's earnings and give it a price today. Unfortunately, companies' earnings are based on the burning energy in the future. And that's where the problem is. Back in the 30s, the stock prices were based on book value. Basically, what the value of the company was worth if all the assets were sold. Today, well, stock price is based on earnings. Earnings can and will implode when the markets crack due to massive debt and falling oil production. And this is going to be a huge problem. Now, we've been looking at the pension problem, and it is getting worse. It's terrible around the country. It is a gigantic Ponzi scheme, and it's going to be a very big problem when everything comes crashing down. Now, we see that the Russian Central Bank, well, it opened its first overseas office in Beijing on March 14, marking a step forward in forging the Beijing-Moscow alliance to bypass, you got it, the U.S. dollar in the global monetary system. Now, we understand that they've been planning on phasing in a gold-backed standard of trade. This is why China has been amassing a huge amount of gold. This is why Russia has been doing the same thing. And they're doing all of this to completely bypass the dollar. And they've been doing this. And we know that Russia is prepared and ready to separate itself from the international banking system, the SWIFT system. China has also worked on that system. And we could see right now, this is exactly what they're planning to do. Bypassing the U.S. dollar appears to be paying off right now. According to the Chinese State Administration of Taxation, trade turnover between China and Russia increased by 34% in January. Bilateral trade in January 2017 amounted to about $6.55 billion. China's exports to Russia grew by 29.5%. Now, what they're doing is they're completely separating themselves. The BRIC countries, well, they have large reserves in gold and an impressive volume of production and consumption of this precious metal. In China, the gold trade is conducted in Shanghai. In Russia, it is in Moscow. And their idea is to create a link between the two cities in order to increase trade between the two markets. In other words, China and Russia right now, they're shifting away from the dollar, and this is the dollar-based trade. That's what they're shifting away from. And they're shifting towards some type of gold-backed trade, some type of Eastern gold standard, one shared between Russia and China, which, of course, will completely bypass the dollar. They will not use the dollar. So we can see the writing is on the wall. It's always been on the wall. And again, things don't happen overnight. Think about when we spoke about China creating its own payment system. When Russia, when they first introduced sanctions, when they said, you know something, we're going to create a whole new system where it's going to be separate and apart from the SWIFT system, and we're going to separate ourselves from the international banking system. Well, this was, a couple years ago. And again, this doesn't happen overnight. They look at the situation, they see what's going on, they have to ramp up the gold over time, they have to create these systems, they have to separate themselves. And I remember going back in time when people would, write in and say this is never going to happen, they're never going to separate themselves. Well, it looks like they're prepared to do so. China's never going to be led into the basket of SDRs, which it was. And we could see at this point that everything that we've talked about years ago is now coming true today. And when we look at the entire situation and we step back and we really take a look, we can definitely see what has been happening. Now, it's much easier to look at everything after the fact and say, oh yes, I see they created their own SWIFT system. I can see they started their own gold exchange. Yes, I can see now they added to the basket of SDRs. I can see that China and Russia have been trading not using the dollar. Yes, it's very easy to go back in time to see all this stuff. But what we have been doing is we've been reporting all of this as it happens. So you're not surprised by it. So you can see what's happening, so you can prepare and you can get ready for what is coming. Now, we've been looking at the economy, the global economy, the U.S. economy. We've been doing the same exact thing. And from the very beginning to now, you can see that a lot has changed. Things aren't getting better. Things are getting worse. More and more retail is closing. A lot of things are starting to make sense. Maybe in the beginning, you were saying, I'll listen to him. A lot of things he says might be true. Other things he sounds a little crazy, a little cuckoo. And now you're saying, something, things he's saying now are coming true, and things are definitely getting worse. More and more retail stores are closing. He did say that about 2 years ago. He did say about 2 years ago that housing prices are going to start coming down, that sales are going to start to shift and not move up anymore. They're going to start heading down. People are going to keep their houses on the market longer and longer. And we're starting to see all of this. And here we are today, and this is why you need to be prepared. This is why you had all this time to get prepared. Because here we are today, and as we move forward, it's not going to improve. It's going to collapse right in front of your eyes. And you don't want to be one of those people looking back in time and going, oh, I should have, could have, I should have listened, I should have done that, now I can see it all, now it all makes sense. Just like in 2008. If I was in 2005 telling you things are going to fall apart, everyone would say, crazy person. 2006, same thing, crazy person. 2008, before it happened, crazy person. Until it happens, those people who were crazy, well, they're not so crazy anymore. And all those people who were serious on the news, telling you the way it was and how it's not going to happen, well, those are the crazy people because they didn't see it. They had no clue. And you look at them going, they had no information that they gave you that helped you out. Actually, it made it worse. So get prepared for what is coming. Listen, everyone, thanks a lot for listening. Be well, be safe.